So I want you to imagine a company that was basically just bleeding money 4 years ago.
Oh, yeah, like totally empty hotel lobbies everywhere.
Exactly. I mean, they were sitting on this catastrophic loss during the height of the pandemic with a balance sheet that would, make any accountant break out in a cold sweat.
Right, a total nightmare.
But today, today they are making so much cash that they actually just shocked the Tokyo Stock Exchange with this massive payout.
It's honestly one of the most fascinating structural turnarounds I've seen in recent market history,
Yeah.
because they didn't just weather the storm and wait for things to go back to normal.
Mhm.
They completely dismantled their old business model.
And built a entirely new machine.
Precisely.
So today, we're doing a deep dive into Greens Co. They're the operator of the Comfort Hotel brand here in Japan.
And we have a huge stack of sources for this one.
We really do. We're looking at their recent financial news flash reports, some really interesting investor blog analysis, and the company's own midterm management plan, the Greens Sustainable Journey 2028.
It's a lot of data. It is. And our mission for this deep dive is to unpack this explosive financial turnaround. We really want to understand their aggressively strong shareholder return policy.
Especially that massive new dividend that has literally everyone talking.
Yes. And we'll figure out what this shift toward an enhanced return phase actually means for you, the individual investor.
Because it's so easy to just look at a surging stock price and get caught up in the hype, right?
Oh, absolutely. The blue sky growth vibe is strong.
Yeah, but we need to look under the hood. We have to see the underlying mechanics of how they are generating this much cash flow.
Right?
And why their response to these broader market regulations is, setting a totally new benchmark for corporate governance in the hospitality sector.
Well, let's start by looking directly at that bombshell announcement from June 12, 2026, because that was the moment where the market realized something fundamental had changed.
The double surprise. Yeah, the double surprise. I saw the headlines, but the actual numbers in those financial flash reports are just staggering. Break down what actually happened on that Tuesday.
So Greenscom put out this massive upward revision to their full-year ordinary profit forecast for June 2026.
Which was already pretty good.
It was. The initial forecast was 6.4 billion yen, but they revised it up to 6.65 billion yen.
Wow.
And net profit surged to 4.5 billion yen. So this marks their fourth consecutive year of record-breaking profits.
4 years in a row.
Yeah. And in a capital-intensive industry that's still recovering from, a generational shock, printing 4 straight years of record profits is just an anomaly.
It's crazy, and the market reaction was explosive. I mean, the stock price surged 6.3% in a single day.
Hitting 2,075 yen.
Right, and I was reading some trader blogs, and they pointed out that the technical indicators formed what they call a golden cross.
Oh, right, with the MCD moving averages.
Exactly, and for those who don't spend their days staring at candlestick charts, that's this rare technical signal where a short-term trend line crosses above a long-term trend line.
It's basically a giant neon BUY signal for algorithmic trading programs.
Yeah, exactly. But the profit numbers weren't the only thing that triggered those algorithms.
No, the real frenzy was about what they decided to do with that profit.
The dividend hike.
A dividend hike. They hiked their annual dividend forecast from 40 yen to 52 yen.
Which is huge.
Especially when you consider that the previous year's dividend was just 35 yen. That is a massive, sudden acceleration in shareholder returns.
Let's put this in perspective for a second. It's like a sports team that doesn't just win the championship, but they decide to buy everyone in the stadium a free hot dog.
That's a great way to look at it.
Right. It's a rare double surprise of both profit growth and direct shareholder rewards. Because a lot of companies might have a great harvest and they generate a massive operating profit, but then they just hoard all those apples in the corporate barn.
Yeah, they tell shareholders, look at all these apples we have on our balance sheet. Aren't you happy?
Exactly. But Greens Co. isn't just showing off the harvest. This 52 yen dividend means they are loading up trucks and delivering baskets of apples directly to your front porch.
And that distinction between operating profit and dividend yield is so vital. I mean, historically in corporate Japan, there's been a deeply ingrained culture of hoarding cash.
Just keeping it in the bank.
Right. A company might have a phenomenal year, but management's instinct was always to pad the bank accounts to protect against future downturns.
So delivering a record-breaking profit and a massive 12 yen dividend jump simultaneously, that sends a message.
A highly confident message. They're telling the market, we don't just have cash today, we believe our earning power is permanent.
But wait, I have to push back here. Running a physical hotel is incredibly expensive right now.
Oh, definitely.
I mean, every time you open a business paper, there are headlines about crushing inflation, severe labor shortages, skyrocketing costs for commercial electricity and linens.
The breakfast supplies, yeah.
Right, so how on earth are they finding the extra cash to pay out these massive dividends without going broke or compromising their daily operations?
Well, you can't just cut your way to a 52 yen dividend in an inflationary environment.
Because the guests would notice.
Exactly. If you slash the cleaning budget or the breakfast quality, you destroy the guest experience and the brand basically dies.
So where's the cash coming from?
They found it by fundamentally overhauling their revenue engine. They implemented a highly sophisticated proprietary revenue management system.
Oh, like dynamic pricing.
Yes, exactly, based on dynamic pricing.
So like the airline industry, where the price of a seat changes constantly based on demand.
It's a very similar concept, but executed at a granular daily level for thousands of individual rooms. They are optimizing their average daily rate, or ADR, alongside their occupancy rates in real time.
How does that algorithm actually work in practice, though?
Well, it analyzes layers of data simultaneously. It looks at historical booking curves, like how quickly a specific hotel usually fills up for a given Tuesday in November.
Okay, that makes sense.
But then it layers on real-time data, local event schedules, major concert announcements, conference bookings, even what competitor hotels down the street are charging at that exact minute.
That is intense.
It is. So if demand is sluggish, the algorithm lowers the price slightly to capture budget-conscious travelers.
Just to make sure the room doesn't sit empty.
Right, because an empty room generates 0 yen, but it still costs money to maintain.
But if there's a massive convention in town...
The algorithm instantly recognizes that spike in search velocity and adjusts the price upward, sometimes significantly.
to capture the maximum willingness to pay from business travelers.
Exactly, especially those whose companies are covering the bill. And by perfectly managing this supply and demand curve, the system generated so much excess margin that it completely absorbed the heavy costs of their new hotel openings.
Wait, really? Just from optimizing the room rates?
Yeah, they effectively funded their own physical expansion and facility renovations in the second half of the year just by being smarter about how they price a night's sleep.
That level of software efficiency is just mind-blowing. But, reading through the demographic data in these reports, something else really stood out to me.
The demographic shift.
Yeah. Pre-pandemic, the entire narrative around Japanese tourism growth was heavily reliant on Chinese inbound travelers.
It was a massive wave of spending.
Huge. So pivoting away from Chinese tourists seems incredibly risky, right? Because they were traditionally the biggest spenders. How does replacing them with Western and Southeast Asian tourists actually improve the balance sheet?
It really comes down to structural risk management. When your revenue is disproportionately tied to a single demographic from a single nation, your balance sheet is incredibly vulnerable to external shocks.
Oh, like geopolitical tensions or travel restrictions?
Exactly, or a specific currency devaluation. Any of that can instantly wipe out your occupancy rates.
So they basically decoupled their reliance on that one specific market.
They did. They aggressively targeted a broader mix. And the data shows they successfully attracted inbound tourists from the U.S., Europe, Australia, and Southeast Asia.
Diversifying the nationalities staying in their beds.
Right. And by doing that, they created a much more risk-resistant revenue base. If the European economy slows down, they still have strong bookings from Australia and North America.
So this demographic pivot proves the sheer resilience of their core earning power. They aren't just riding a single macroeconomic wave anymore.
They engineered a highly stable foundation.
Okay, but I still have to wonder about sustainability here. Dynamic pricing is great, but isn't there a ceiling?
What do you mean?
Well, at what point do business travelers and families just say, no thanks, that's too expensive? How far can this blue sky growth really go? Because paying out this massive 52 yen dividend right now seems almost reckless. Why not save that diversified cash flow for a rainy day?
That's the big crucian. But this is where we have to look beyond Greensco and understand the seismic shift happening across the Japanese stock market.
Oh, the Tokyo Stock Exchange mandate?
Yes, this 52 yen dividend is not happening in a vacuum.
Yeah.
It is a direct, aggressive response to mandates from the TSE.
And the TSE has been getting incredibly strict lately.
Very strict. They have drawn a line in the sand regarding what investors call lazy balance sheets.
Right, going back to what we said earlier about executives historically hoarding cash as prudent management.
Exactly. The TSE basically declared that this practice suppresses the value of the entire Japanese market. They mandated that listed companies must run their operations with a hyper-awareness of their cost of capital and their stock price.
So they're essentially telling these corporate boards, if you want the prestige of being listed here, you need to actively work to improve your valuation and actually reward the people who give you their capital.
That's exactly it. And Greensco is using this massive dividend hike as a very loud declaration to the TSE and institutional investors.
They're saying, message received, look at our capital efficiency.
Yeah. And it's fascinating when you contrast it with their direct competitors.
Oh, like Keiretsu Maintenance.
Right. The analyses point out that other major players like Keiretsu Maintenance are issuing very conservative forecasts. They are playing it safe, keeping their cards close to their chest.
While Greensco is out on the attack, actively breaking those conservative industry norms.
But going on the attack required some serious financial house cleaning first.
Yeah, let's talk about that. Because during the darkest days of the pandemic, just to keep the lights on, their equity ratio collapsed to a highly dangerous 5.2% in fiscal year 2022.
They were heavily leveraged.
Deeply reliant on preferred stock.
And we should definitely define that because
Right.
preferred stock functions quite differently from the common stock you or I might buy on an exchange.
Right. How does it work for a company in distress?
Well, it acts a bit like expensive debt. It injects necessary capital, but it usually comes with strict obligations, like guaranteed, prioritized dividend payouts.
Payouts that drain cash flow before common shareholders see a single yen.
Exactly. But the financial reports show they drastically improved that situation.
Yeah, they hauled their equity ratio all the way up to 22.6% by fiscal year 2023.
By aggressively retiring that preferred stock. And that retirement is the mechanical trigger for this new dividend policy.
You know, it's a lot like personal finance. It's like finally paying off your high-interest credit card debt.
Yes.
Every single month, a huge chunk of your paycheck just vanishes to service that obligation, and you never feel any wealthier. But the day you make that final payment and close the account,
Suddenly your monthly cash flow explodes.
exactly, you have all this extra cash in your checking account to actually invest, enjoy your life, or, you know, in this case, pay a massive 52 yen dividend to your shareholders.
That is a perfect analogy. Because the redemption cycle for that expensive preferred stock is ending. The cash flow that was previously trapped servicing it is now freed up.
And this is what the analysts mean when they say Greensco is entering a true enhanced return phase.
Right. For common shareholders, they are no longer focused just on survival or debt service. They're fundamentally positioned to prioritize the people holding their common stock.
Which leads to a metric that honestly blew my mind when I read it. They are now targeting a return on equity, or ROE, of over 20%.
And that is the number that makes institutional investors sit up and take notes.
To put that 20% ROE in perspective, for every dollar of investor money sitting in the company's equity base, they are generating 20 cents of pure profit a year.
In a capital-heavy industry like hospitality.
Right. Where you have to constantly maintain physical buildings, replace furniture, pay thousands of staff members. Hitting that number requires an incredibly lean, ruthless efficiency.
Especially since historically, the average Japanese corporate ROE hovers comfortably in the single digits.
Exactly. So hitting 20% signifies a total shift in philosophy.
They aren't trying to just grow their top-line revenue for the sake of empire building. They're focused on generating maximum profit for every single unit of capital deployed.
So as an investor, you see the credit card debt paid off, you see the 52 yen dividend hit your account, and you see this 20% ROE target.
It looks fantastic.
It does, but the natural question is, are these just the good times rolling, or is this actually sustainable? Because if they're emptying their coffers to pay this massive dividend today, how are they planning to fund their long-term growth?
And that tension between rewarding shareholders today and funding the business of tomorrow is the ultimate test of management.
So how are they threading that needle?
To see that, we have to look at their midterm management plan, the Green Sustainable Journey 2028.
The targets in this 2028 plan are super ambitious. I mean, they want to hit 60 billion yen in revenue by fiscal year 2028.
And they're planning to expand their footprint to 15,000 rooms nationwide.
But what caught my eye isn't just the sheer number of rooms, it's where they are putting them. They aren't just trying to cram more luxury high-rises into downtown Tokyo.
No, the plan explicitly outlines a major push into roadside-type hotels.
And capturing regional leisure demand.
It's a very calculated diversification of their physical footprint, which mirrors how they diversify their tourist demographics.
Oh, that's a good point. By expanding into the regions and building roadside infrastructure, they are capturing the domestic family road trip market.
And regional business travelers.
Yeah.
They are actively lowering their reliance on major metropolitan hubs, which can be highly sensitive to economic fluctuations.
But expanding to 15,000 rooms requires serious capital, and the reports do note that despite their aggressive financial cleanup, they still hold about 4 billion yen in preferred stock.
Right, it hasn't vanished entirely.
Yet their explicit policy in the 2028 plan is to maintain stable dividends. They outline a formula where they'll determine the payout by factoring in single-year performance, the dividend payout ratio, and that 20% ROE target.
So they are communicating a very clear balancing act to the market. They are acknowledging that they're still funding aggressive physical expansion and managing some preferred stock obligations.
But crucially, they are committing to this enhanced return phase.
Exactly. They are proving that a company can simultaneously fund growth, manage debt, and deliver industry-leading shareholder yields.
And it isn't all just financial engineering and algorithm optimization either.
Oh.
Because a huge pillar of this 2028 Sustainable Journey Plan leans heavily into ESG investments, environmental, social, and governance.
And often, ESG initiatives in corporate reports can read like, marketing fluff.
Yeah, totally. But Greensco is integrating these practices directly into their operational model. The specific initiatives actually surprised me.
Like what?
Well, they're actively developing restaurant menus in collaboration with local regional businesses. They're funding and running children's cafeterias to support local communities.
Wow.
And they're placing a massive emphasis on D&I diversity and inclusion, investing heavily in human capital.
Which is really smart.
But on the surface, funding children's cafeterias and local business collaborations sounds like pure charity. How does that align with a ruthless focus on a 20% ROE and paying out a 52 yen dividend?
It aligns perfectly when you understand the most severe threat facing the Japanese economy right now.
The demographic cliff?
Yes. Japan is rapidly running out of young workers. The service sector is already experiencing crippling labor shortages.
And high turnover in hospitality is incredibly expensive. Recruiting, training, and lost productivity drain cash directly from the bottom line.
Precisely. By investing in an inclusive workplace and integrating deeply with the local community through things like the cafeterias, Greensco is building a protective moat around their workforce.
Oh, I see. Because employees are far more likely to stay with a company that actively supports their local community.
Right. And offers an inclusive environment. It builds immense brand loyalty, not just with guests, but with the labor pool itself.
And lower turnover directly reduces operational friction and costs.
Which in turn protects those high profit margins, sustains the 20% ROE, and ultimately funds the dividend.
So the social investment is actually a mechanism for financial protection. I mean, you can't sustain a 20% return on equity if your hotels are chronically understaffed because no one wants to work for you.
Exactly. They recognize that sustainable financial returns are impossible without sustainable human capital practices. They are proving that you don't have to choose between pleasing institutional investors and supporting your frontline staff.
One directly fuels the other.
Absolutely.
Let's synthesize this journey because the transformation here is really profound. We started by looking at a company staring into the abyss during a global travel freeze.
Bleeding cash and burdened with expensive preferred stock.
Right. And through a systematic, multi-year process, they totally rebuilt their foundation. They deployed dynamic pricing algorithms to optimize revenue on every single room.
Absorbing the costs of their own expansion.
Yes. They diversified their target tourist demographics to insulate the company from regional economic shocks. And they aggressively cleaned up their balance sheet, paying down that expensive preferred stock to free up cash flow.
Which allowed them to answer the Tokyo Stock Exchange's call to eliminate lazy balance sheets.
And enter this enhanced return phase, surprising the market with a record profit and a massive 52 yen dividend.
All while maintaining a 20% ROE. And building a social moat around their workforce to protect their future growth to 15,000 rooms by 2028.
It's honestly a masterclass in modern corporate governance. They took the traditional conservative playbook of the Japanese hospitality industry and completely rewrote it.
They have set a completely new standard for capital efficiency in the sector.
They really have. Which leaves us with a fascinating dynamic to watch going forward. Because Greensco just threw down the gauntlet. They proved that a company can generate record profits, expand their footprint, invest deeply in their people, and hand out massive market-shocking dividends.
The pressure is certainly on the rest of the industry now.
It is. So the question every investor has to be asking themselves right now is this: will this aggressive, loud dividend policy force their competitors to finally wake up?
It's a great question.
If executives at legacy hotel chains are watching Green's Co. get rewarded by the market with a surging stock price and glowing analyst reports, how long can they afford to hoard their cash in the barn?
Not long, you'd think.
Right. What other sleeping giant stocks in the Japanese hospitality sector are sitting on lazy balance sheets just waiting to be pressured into paying out? Because if Green's Co. is any indication, the era of hoarding cash is over, and you definitely want to be holding a ticket when the rest of the industry decides to follow suit.
It will be very revealing to see who adapts and who gets left behind.
We will definitely keep tracking the filings. Until next time, keep digging into the data.